Hello, everyone, and thank you very much for joining us for the Nasdaq Dorsey Wright podcast on this Wednesday, July 22nd. My name is Ian Saunders, and we have a very special edition of the podcast this week. Joining us this week on the podcast is going to be Brendan Ahern, who's the Chief Investment Officer at KraneShares. KraneShares is a firm that we have partnered with there towards the end of 2019 to bring forth a model on the platform. Been a great partner of Dorsey Wright throughout the years as well. Definitely been an ongoing relationship, and we're very excited to see it ramp up here recently, and very excited about the prospects to come. Brendan, as I mentioned, is the CIO of KraneShares. He also is the author of a blog, China Last Night, and it comes out there each morning. Brendan, just saw the email hit my inbox here just a minute ago. So just that has a lot of great content. And so to get our listeners up to speed with everything that's been going on over in China, I know that we've been in the U.S. here on our side of things, been a lot of interesting movement and on the backs of the continued COVID crisis. But China seems to they were one of the first ones into the issue there, and I've heard you mention in the past, right, kind of the first in first out situation. How are things looking over on that front?
Yeah, no, I think certainly, yeah, China is kind of FIFO, has exited coronavirus. I think it's not just a China thing, but in broader Asia, they've unfortunately had several of these pandemics over the last 20 years, and so there's a real game plan when something like this happens, and when they say don't leave your apartment, you don't leave your apartment. I would look at, Vietnam has, 100 million people population-wise, under 400 cases, not one death, 25 million people in Taiwan, under 500 cases. And so China did implement a strict quarantines, similar to what we've seen across Asia. And that has allowed them to really stamp out coronavirus without a cure, without a vaccine, and return to work. And they return to work. I mean, I think it is important to note, they return to work out of economic necessity. And so we are seeing a V-shaped rebound in terms of the economic data out of China today.
Certainly seeing the at least a semblance of V-shaped recovery there, and a lot of in a lot of share prices and whatnot over there as well. What areas have you seen that have kind of led the way in terms of at least on the equity front over there that have helped bring the markets back up towards previous or hitting new highs there as well?
Well, I think in China and really what's happening globally is people, if you're spending more time in your apartment or your house in China, and remember the quarantine showed up in the Q1 earnings, and what we saw definitively in the case of China was you saw a big increase in e-commerce, online education, social media, downloading TV shows, movies, music, online gaming. And so a lot of these kind of asset-light growth companies, performed very well. Tencent, it's more than $500 billion market cap company, grew revenue over 20%. Their online gaming unit grew over 30%. But we saw the same with, say, Alibaba, another $500 billion market cap company in Q1, grew revenue over 20%. So I think one, there's we can kind of use China as a guidepost for what we can expect, as they have exited Corona. That baton is also going to get handed off to Asia, where we had a very serious, quarantine, social distancing measures, but also in Europe. A little further afield, you've got India, you've got South America, unfortunately, are still in the thick of this, and to some degree, here in the United States as well. So, but these internet e-commerce companies in some ways benefited from the quarantines.
Absolutely, Brendan, and continue to see that V-shaped recovery there, especially in a lot of the those as you mentioned, the China internet continuing to pave the way or lead a lot of those areas higher within China. At least what we've seen here from our technical perspective. Mainly looking at one of your funds there, looking at the China Internet ETF, KraneShares China Internet ETF, KWEB. That has been a big outperformer there among the Chinese equity space. But we've also seen especially some recent improvement from some of the other emerging market areas, as you touched on there as well. So do you think that some of that improvement is really kind of tied to just the continued strength following the leader, that China leader higher, or is some of that looking at some of the other areas out there really showing either maybe declining COVID cases themselves, or just kind of their own economies moving a bit out of this as well?
Yeah, I mean, I think we're definitely seeing that, China was kind of FIFO, and now they're handing the baton to other countries across Asia. And as those markets come back, you're seeing this disparity between value and growth. The KOSPI, the South Korean benchmark, is up only about 1%, but the KOSDAQ, which is more of a Nasdaq, growth geared exchange, is up 18%. Within mainland China, you have the Shanghai comp, which is really mega cap, large cap, kind of old economy stocks, is up 9%, versus the Shenzhen, which is more mid, small cap, more growth geared companies, is up 30%. So I think, you're seeing coming out of quarantines that the growth companies are leading the way higher. And in China, there's actual evidence further of this. We can tell from, broad retail sales for the month of June, you posted a modest decline. But if you go a little bit further, online sales actually went up almost 30% in the month of June, whereas the offline, more traditional actual stores was down about 10%. So I think that's important because we can kind of use China as a little bit of a guidepost for what's going to happen in Asia and Europe, and eventually further afield, South America, as well as here in the United States. And it shows that without a cure or vaccine, people who are older in age with pre-existing health conditions are going to continue to take precautions that those that are more susceptible to coronavirus, the virus becoming COVID-19, the disease, you're going to take precautions. And so a lot of these habits that were formed during the quarantine are sticking. And so to some degree, as investors, I think the market's kind of figuring this out and saying that these growth geared internet e-commerce companies have a bit of an advantage over the more traditional retailers. And I think that's an important lesson for U.S. investors if you're thinking about, how as we come back online.
Absolutely. And one thing you mentioned there was taking a look at the virus headlines we've continued to see pop up, at least in the U.S. news, and continue to see kind of outperformance from China healthcare related companies too. But at least for me personally, I'm sure a lot of others around here in the U.S. Aren't necessarily as familiar with the China healthcare space. I mean, I'm sure it's vastly different than the space that we have here in the U.S., and at least in terms of its structure. But how are they doing on that front in the healthcare space, and then specifically around the vaccine related trials and content that they have going on over there?
Yeah. I mean, certainly there is a element of a manufacturing around Chinese healthcare. If it's ventilators, PPE, as well as a lot of drugs are manufactured in China. So there's obviously both domestic as well as international demand. And our China healthcare ETF has, really performed well. And, I think, what's kind of interesting is, healthcare within broad emerging markets is only like 4% of the index. And so you have very little exposure to Chinese as well as Indian companies that are really manufacturing a lot of the medical equipment and drugs that's in significant demand today. And I think it's an area where we've actually seen Chinese pharmaceutical companies in phase 3 clinical trials in the UAE. They're planning on testing it something like I think it's like 100,000 people are going to be given the vaccine, including the senior members of the health ministry. And so, it's potential that, we could see a Chinese company come out with a vaccine just based on how far along they are in terms of, a phase 3 trial is, shows that their willingness to actually administer this drug to a large segment of the UAE's population. It's potentially a cure, or a vaccine rather, is coming from a Chinese company.
And so it'd certainly be something to keep an eye out for. And then, as you mentioned there, KURE continue to push higher as well. And pivoting into that a little bit. I've heard one of the terms referenced that you referenced there in the China Last Night blog that you have is the D&D trade. That it was a term that was new to me before seeing it there, and that was looking at drugs and drinks. Was that right?
Yeah. Really. Liquor and alcohol stocks and healthcare stocks have really been the darlings for investors in mainland China. Quechua Mutai is now the largest alcohol company globally, famous in China for the baju, which is a fiery liquor. It comes in a can that almost looks like a Valvoline oil can, and I think it's a little bit of an acquired taste. But alcohol sales have been very robust. It's kind of interesting. Alcohol is actually considered a staples. So Quechua Mutai and several of its competitors have done very well. And then certainly, I think investors in mainland China have recognized the demand, the potential revenue we're going to see for Chinese healthcare companies.
Certainly, and as you mentioned there too, in looking at pivoting back to the conversation that you were discussing there, looking at the kind of old versus new China sectors. Another point that I thought has been especially interesting here recently was comments that we'd seen around the indexing side of China. The index is picking up more and more shares of these new companies. There is in looking at that as well. The broader emerging markets indexes have continued to pick up more China exposure over the past couple of years, and we've seen that reflected, especially in the performance recently of some of those broad emerging markets funds and indexes that we've seen vast outperformance of emerging markets over the developed side of things, especially over the past couple of weeks here. But in looking at a different side of the coin and looking at things maybe from the foreign exchange side of things, we've seen recent continued deterioration from the U.S. dollar. The U.S. dollar, the ticker there on our platform, DX/Y, continuing lower. Actually there yesterday to print its second consecutive sell signal on that default chart there that we have on the Nasdaq Dorsey Wright platform. So definitely continue to show deterioration, really ramped up deterioration over the past week or two here. What kind of effect do you think that China might have on that, or how do you see that playing out to the broader emerging market space as a whole here moving forward?
Yeah, China's unique in that they've not cut interest rates. And so, China's currency has been very, very stable throughout these political, rhetoric headlines. The currency's really not done much, and I think some of this is very simply because interest rates in China have not been cut, and you're seeing other countries in the EM space have cut interest rates, like say for instance in Brazil. So So the currency actually has been a bit of a tailwind for investors like ourselves, and KBA's or MSCI China A ETF. It's actually been additive to have that renminbi exposure, and I think they've been very pragmatic in providing stimulus on an incremental basis. It's been more geared to helping private companies, kind of small, medium enterprises gain access to credit. But they've kept a lot of powder dry, and I think the best evidence of that is not cutting the broad interest rate. And relative to both Europe and here in the United States, that's pretty healthy. I think it's a very strong sign on the stability we're seeing within China economically.
Certainly there. And so would you look at the declining dollar then to have more of a continued effect on maybe some of the continued outperformance of some other emerging markets areas in the China Asia region over there?
Yeah, I mean, I think stepping back, I kind of view as a financial advisor, if the more you've diversified, the worse you've done, because for 12 years the S&P 500 has been the only game in town. The S&P 500 since the global financial crisis low is up 509%, and MSCI emerging markets is only up 206%. And I think that's being reflected. I just think about as an advisor, every quarter you have to explain why you're doing modern portfolio theory asset allocation, and it's being detrimental due to the one-way nature of U.S. equity markets. But about $14 billion has come out of the three largest EM ETFs year to date, and I think one of that is we've had a strong dollar up until recently. Commodities have done very poorly up until very recently. And then the other factor has just been, the EM benchmark has heavy weights to financials, energy, industrials, materials, utilities, and real estate. Those are value sectors, and we're in a growth geared market. I think if you looked at a growth sector within EM, technology is up 671% versus the S&P's up 509. So I think if you step back and say, we've been in this growth geared market, to get exposure to growth in EM, you've had to take a more nuanced approach. And I think, KWeb, our China internet e-commerce has performed very well. At the same time, I'm very constructive on KEMQ, which is our EM consumer technology ETF. And it basically takes a bottom-up approach and pulls out a lot of these internet e-commerce mobile payment companies out of the broad benchmark. And I think if we think about the potential for an EM outperformance, I want to own these growth names, in my opinion, over the broad benchmark because of its big sector weights to value-oriented companies.
Absolutely. And we've seen that especially reflected here recently in that continued outperformance, and more people, seemingly more investors piling into those emerging market areas. On that front, one additional question here. Without getting kind of too in the political realm of things, been a lot of headlines around the potential delisting of some of the Chinese shares here in the U.S. So I was wondering, provide any kind of further clarification or maybe some kind of timeline thing on what that actually is, maybe a little bit deeper dive than just the broad headlines we may see flashing up across the screen on what that could look like here moving forward.
Yeah, certainly the Senate did pass a bill. It was passed by what's called unanimous consent, which means they didn't even vote on this bill. It kind of got put up, and because not one senator objected to the bill, it said that if Chinese companies don't allow the audit books to be released to the PCAOB in 3 years, they could be delisted. And I think, we're seeing that this really woke up when the Senate bill passed. it really woke up the U.S. financial industry because these Chinese companies are a profit center for U.S. investment bankers. Alibaba, when they went public, they paid U.S. investment banks $300 million. They're a profit center for exchanges. These are growth-geared companies within EM, so they're heavily held. Ultimately, this is kind of an accounting nuance. The Ernst & Young discovered the luck and fraud during its annual audit. So the audits work. And China should adhere to the global standard, but delisting these companies is, in my opinion, just a terrible idea. That 1.2 trillion of market cap is held by U.S. investors, not Chinese investors, and hurting U.S. savers during a recession is just a absolutely terrible idea. And for what it's worth, we at KraneShares have been trying to shed light on this. And it's for a long time, I'll be candid, we've felt very lonely in those efforts, and it's good to hear the U.S. financial industry has finally woken up to this. And one thing I'd point out, Ian, is that the current SEC chairman, Jay Clayton, if you Google Alibaba IPO prospectus, on the first page of that document, you'll see Jay Clayton, when at the law firm he used to work for, helped bring Alibaba public. And I think the hypocrisy of what's happening, he helped bring it public, and I think that's something that it's just worth pointing out.
Absolutely. It'll certainly be an interesting point to continue to monitor here, as I'm sure that the headlines will continue to do so as this continues to play out. And so in pivoting back there to the broader space of the Chinese equities there, I mean, and moving forward throughout the second half of the year, any particular places you all are continuing to keep an eye on there to see about continue to pull China higher and as we head towards the end of the year here?
Yeah, I mean, I think one of the things that's happened is if you look at recently the IPO market in Hong Kong has just been on fire, and some of that has been driven by U.S. listed Chinese companies. Really not necessarily because of the PCAOB, the delisting issue, but if you look at Alibaba, for the calendar year, at the end of calendar year 2017, they generated $23 billion. By the end of 2019, that had doubled to $56 billion. But over that time period, because of the political headlines, the stock didn't move. So in November of last year, they actually relisted in Hong Kong. They basically said U.S. investors aren't properly valuing our stock. That the fundamentals were so strong, revenue doubled, but the stock didn't double. It was flat. And so after they went, we've seen JD.com relist in Hong Kong. We've seen NetEase relist. It's rumored that Yum China, Pinduo, Duo, Baidu are going to follow, and they are getting. I mean, it's true. Alibaba year to date is doing much better by having a Hong Kong listing, and I think it just shows that this political headlines has kept these good stocks down a little bit. We benefit. Simply because, there is fungibility, there's convertibility between the two share classes. And now we're hearing Ant Financial, the mobile payment behemoth, could go public in Hong Kong. And we're going to see Asian indices like the Hang Seng very likely add Alibaba They'll announce it in August. It'll get added to the Hang Seng, so there'll be a lot of passive flows. And in September, we find out if Alibaba's Hong Kong listing will be added to Southbound Stock Connect, which would mean investors in mainland China can buy the stock for the first time. And that makes us very constructive on these Chinese internet and e-commerce companies. And I think it's something to watch. Ant Group going public is going to be it'll probably, I think it's without question, it would be the biggest IPO this year.
That will certainly be. And so with Ant Group, they're a payments platform, you said, right?
Yeah. So Alibaba owns a third of Ant Financial. So Alibaba, runs these internet sales, Tmall and Taobao. And when you buy something like if you bought on Amazon, it's like the PayPal. But China, they've kind of leapfrogged where, the things in your wallet or purse are obsolete in China. You don't need cash. You don't need credit cards or ATM cards because your phone is your wallet. And Ant Group has just dominated that space. Tencent does have a competitor called WePay. It's part of their WeChat social media platform, but Ant Group is. I mean, they literally make PayPal look like a rounding error in terms of the amount of transactions.
Goodness, that's certainly not something you hear every day there, especially from something like PayPal.
Oh yeah. I mean, it's. I mean, the numbers are just kind of mind-boggling. But if you think about the tens of billions of dollars worth of goods sold via Alibaba's e-commerce platforms, it's all through Alipay.
Well, sounds like there's no shortage of things to continue to keep an eye. Sorry.
Yeah, I was just going to say, in 2019, it was estimated about $8 trillion of mobile payments in China. And Alipay has more than a 50% market share.
Goodness. Goodness. Well, Brendan, it sounds like there's no shortage of things to continue to keep an eye out there, and we'll continue to keep an eye out here on our end as well. First, thank you very much for joining us here on the podcast and continuing the partnership that we have here. For anyone who's looking to continue to follow, as we mentioned there, the model that we have on the Nasdaq Dorsey Wright platform, that can be found there under the models listing page. And obviously, you're more than welcome to reach out to us here, the Nasdaq Dorsey Wright analyst team, with any kind of questions you have on this, on any of the charts that we mentioned there, or really anything at all. More than welcome to reach out to us there by phone at 804-320-8511, or by email as well at dwa@dorseyright.com. So with that there, Brendan, thank you very much for joining us here this week.
Hey, my pleasure, Ian. And yeah, by all means, it's great to hear that you're reading China Last Night yourself.
Certainly. And for those that are looking for the China Last Night as well, I believe it's just ChinaLastNight.com. Is that right, Brendan?
Yep, that's it.
All right. Well, with that, again, thank you for joining us, and thank you all very much for listening here this week. And we look forward to having you back next week.